Hello everyone, welcome to the Alpha Hustle. This is the first of the educational videos in the Market Profile Paatshaala series with the aim to help get started with Market Profile. Alright, so let's dive into chapter 1. An honest disclaimer before getting into further details, Market Profile should only be viewed as charting technique rather than a trading system that generates buy and sell signals. So if you are one who is in search of a trading system, I would advise to give this a pass. So before we jump into the details of market profile, let's understand what price and how auction market works. Price is nothing but an advertising mechanism between the buyers and the sellers that is regulated by time. So in the financial markets context, the buyers would have a bid price, whereas the sellers would have an ask price. So each of these market participants are trying to advertise their price, and if there is a match between the bid price and the ask price, the transaction gets executed. However, does the price always moves in one direction, either in a straight line upwards or in a straight line downwards? Absolutely not. So market is a two-way auction process. An end of an auction is a start of another auction. So what does this mean? So let's say there is quite a demand for a particular asset, be it a car or a house. As the demand increases, bidders start bidding for higher prices, where the seller starts to ask for higher prices. So this tends to start an auction to the upside. The auction stalls when the last bidder bids, which will initiate the auction to the downside. So an end of an upward auction is a start of a downward auction. Similarly, when the market goes down to the point where it finds the last seller. Once the strong buyer or bidder bids and stops the downward auction, it is the start of an upward auction. So let's take an example of an auction at an art gallery to draw similarities with the financial markets. Auctioneer starts off the bidding process saying that a piece of art costs, say, 1 lakh rupees, where no one wants to lift the bid. Auctioneer starts to add fillers, talking about the art, details of the artist, etc. Starts to lower the prices to say 90,000, where a buyer steps in to take the auction higher. So buyer bids and then the auction continues. So the buyers who didn't want to lift the bid for 1 lakh rupees may now be willing to bid at 1.5 lakhs, suggesting that the value has shifted higher. So this process continues until the last bidder bids. So financial markets across the globe are no different, where the upward auction continues till the last bidder bids, while the downward auction continues till the last seller sells. So what is a profile? Profile is nothing but arranging the price regulated by time in a Gaussian normal distribution, where the volume remains thin on the range extremes with heavily traded prices in between. So the nice bell-shaped curve shows statistical probability of 68% of the price, where the prices spend most of the time auctioning, called one standard deviation. While the range extremes, where there is thinly traded volume, are two standard deviation with a 95% probability, and a third standard deviation which has got 99% probability. So we'll get into more details when we talk about the value area, range extremes, buying tails and selling tails in the subsequent sessions. So what is market profile and why does it fascinate me? A normal candlestick charts provides a two-dimensional view of price, where the market profile provides a three-dimensional view of price, time, and volume. So this helps in understanding the little nuances of price advertising mechanism that may not be clearly visible in a candlestick chart. We shall learn more of such nuances in the future. But to start off with, the basic element of a market profile is called TPO, time, price, opportunity. As we just discussed, price is an advertising mechanism that's regulated by time. The market starts at 9:15, ends at 3:30 no matter what. So within this stipulated time, the price advertises where the buyers and the sellers find some opportunities. So every point where the price trades is plotted by an alphabet. So each letter is called a TPO. So if you kind of relate the candlestick charts with the market profile charts, it's nothing but a representation of a 30-minute candles with alphabets. So the D prints that you see here is nothing but the first green candle on the candlestick charts. Similarly, letter E represents the second red candle in the candlestick charts. So every price point at any particular time is represented by an alphabet. As the price moves higher, more TPOs gets plotted to the upside, while the price moves lower, more TPOs gets plotted towards the downside. A new alphabet gets printed when we start to form a new 30-minute candle. So perfect balance day once collapsed shall form a nice bell-shaped curve that we have seen earlier. And the zone at which the prices spend the majority of the time, approximately 68% to 70%, is called the value area. So this is nothing but the one standard deviation as per normal distribution that we have just seen. The fairest price at which the business is conducted is called point of control, which is nothing but the price at which we've got the maximum number of TPOs plotted. So in this picture, this zone that's highlighted with a black dot and an orange bar, the point of control is quite an important concept along with the value area. We shall talk about the point of controls, the prominent point of controls, and the value area in the subsequent chapters. Peter Stradelmeyer, who discovered the market profile or started arranging the prices within a Gaussian normal distribution model, termed the first hour of the trading session, which is denoted by A and B periods in this picture, is called initial balance. So initial balance is nothing but the first hour of trading. It's used by the price action concept as an opening range breakout or trading within the opening range, etc. But we'll get into the more details when we talk about the day types on why the initial balance is important, which gives us an understanding in terms of who the market participants are within that particular trading session. Do we always have this nice bell-shaped curve as shown in this picture? Absolutely not. Markets move from balance into imbalance and back into balance again. So as we just discussed, a market doesn't have a unidirectional move. It's a two-way auction process. So it starts off from a balance, from where an imbalance starts, and then eventually gets into a balance back again before starting another imbalance move. Balance is nothing but prices trading sideways, where imbalance is making a trending move out of a balance. Richard Wyckoff beautifully represented in his Wyckoff market cycle, where accumulation or distribution phases can be attributed to the balance, whereas markup and the markdown phases as an imbalance move. As the diffusion model states, innovators and early adapters enter the balance phase where they either accumulate their long positions or distribute their long positions. So once they're done with their job, they would start an imbalance move, or rather called a markup or markdown phase in terms of the diffusion model. So balance, imbalance, excess, which I'm going to talk about in the subsequent chapters, are some powerful concepts of market profile. So having said that, now let's look into different types of market participants who drive the two-way auction process. So we could kind of categorize the different market participants into two categories. One, the day time frame. So these are the ones who have a short-term interest in the market. So example of scalpers, intraday traders, they come into the market with zero positions and go home with zero positions. As Jim Dalton says, markets are visual in nature. These are the type of the traders who trade visual references like previous day's highs, previous day's lows, point of controls, etc. We look into those static or dynamic references in the subsequent sessions, but daytime frame traders are nothing but short-term retail traders, if I may put it bluntly. The other sect of traders are the other time frame traders. So these are the ones who have got an intermediate to longer term holding capacity and are generally termed as smart money, who are basically innovators or early adapters. So these are the ones who drive the markets, where daytime frame traders create liquidity in the market. Depending on presence of these market participants within a trading sessions, we would develop a different day types or profiles that get formed. These are categorized into balanced days and imbalanced days. Okay, we'll start with the first of the three balanced day types. So normal day. Normal day is a balanced profile with a wider initial balance. So initial balance is nothing but, as we discussed, the first hour of the trading session. So which is two 30-minute candles. So two 30-minute single prints. So D and E periods in this picture forms the initial balance. So as you can see, the initial balance is quite wide, and this is generally created by the other time frame or OTF, where the day time frame traders get active within this initial balance for the rest of the day, trading initial balance range extremes. So the initial balance high, initial balance low are some important references that would work for a normal type of a day, where the sellers try to sell towards the initial balance high, cover their positions towards the initial balance low. buy towards the initial balance low and cover their positions around the initial balance high. So this is a typical rotational day where prices often revert back to the mean, which is the point of control. This type of the day suggests that there is low confidence among the market participants and an indecisiveness, which would lead to probably a start of an imbalance in the subsequent sessions. The second day type within the balanced day types is the neutral center day. Neutral center day is a balance profile where the initial balance is smaller than the normal day that we have just seen and occurs where there is no strong conviction from the other time frame market participants who try to extend the range. In this example, the OTF tried to extend the range to the upside in the F period above the initial balance high, fails to get a follow through, and starts to liquidate towards the initial balance low, which is the D period low. However, the sellers are not confident enough to where they couldn't get a follow through below the M period, which where the prices extended the range below the initial balance and eventually failed to revert back to the mean, which is a point of control. Again, this is more of a rotational day type where we'll have failed auctions on the either of the range extremes above the initial balance high and below the initial balance low. The third and the last of the balanced day types is a non-trend day. So non-trend day is represented by very small initial balance. As you can see, when compared to normal and the neutral days, the non-trend day has got a very narrow initial balance with no presence of OTF within the market. So these type of days occur ahead of the events prior to RBI policy or before election results, etc., where the market participants await for more market generated information. So this suggests that there is low confidence or conviction within the markets. Now that we are done with the balanced day types, let's move on to the imbalanced day types. The first of the imbalanced day types is a trend day. Trend day marks the highest confidence of the day types where the one time frame takes the control of the market auction right from the open to the close, making one time framing higher. So one time framing is nothing but making higher highs and higher lows on a 30-minute time frame. If the lows of the earlier 30 minutes hasn't been breached, we can say that the market is one time framing to the upside. Trend day that you're seeing on my screen right now is a double distribution or a triple distribution trend day and not a typical trend day. So generally a typical trend day will have quite a bit of elongation. Will start at one point, drive the markets with the one time framing, closing at the high point of the day with more of an elongated profile, suggests that we have a strong trend day and the buyers have been strong in driving the auction either to the upside or if the sellers are strong enough to drive the auction to the downside. The double distribution trend day on the other side is kind of a slightly lower confidence trend day where the market participants distribute for the first hour or couple of hours during the trading session from where OTF drives the prices out of the balance, suggesting that the value has changed from what it was a couple of hours ago and then starts to develop another value or distribute at higher levels. The second imbalance day type is a normal variation day where the market starts off with a small range initial balance. As you can see, the D and E periods are quite narrow in nature. That's formed by the day time frame traders, and the OTF enters the market in F period and G period and starts to take out the initial balance low and extend the range to the downside. So this suggests that higher time frames or the other time frame sellers are driving the markets lower in one direction with confidence. So the final imbalance day type is a neutral extreme day is formed when the market participants try to extend the range on either side above the initial balance high or the initial balance low, fails to get a follow through that eventually extends the range on the other side of the balance. So in this example below, DTF attempts to extend the range in F, G, and H periods above the initial balance high, where they fail to get a follow through. OTF takes the control in the market to extend the range below the initial balance low and eventually close within the range extension below the initial balance low. So this represents some low confidence when compared to the typical trend day or the normal variation day. This represents that the low confidence market is turning into a high confidence market. So understanding and anticipating the day types early in the session helps in avoiding the trades that go against the trend For example, fading a trend day is suicidal. Likewise, looking for directional trades on a non-trend or a normal day creates fatigue, and especially for the option buyers who try to buy the options and sit expecting a directional move, and not having a directional move would have a theta impact and then eventually erode their premium. Understanding the different day types and probably anticipating early in the game would give you the edge in understanding how we may develop our auction for the rest of the day. So let's take a pause here. We shall look into the different open types and how the confidence can be measured in the next chapter. So that's the end of the chapter 1. If you find this content useful, please do like, share, and subscribe. Thank you.